All right. Anybody just joining us here that missed out on the live stream, I'm proud to present you once again, Dave Sather, founder of Sather Financial Group and the guest of our 1000 Entrepreneurs series in the past. Dave and his team last year celebrated their 20th anniversary working together, managing approximately $850 million in assets. They've also been named for the fourth time in the last 5 years to the Financial Times Top 300 Registered Investment Advisors, and some of the students at Texas Lutheran University have won the Texas Investment Portfolio Managers Competition for the last 3 years in a row, so they've had their own successes as well. The purpose of this video, during our live stream, we weren't able to cover all of the questions that we got from our wonderful chat and audience, so we're going to go ahead and get all those questions answered for you now. So we'll go ahead and dive in here, Dave. Looks like the first question in our list that we weren't able to make it to is from a Jorge Medina, who actually was viewing from Lima, Peru, if you can believe that. He would like to know if you have any thoughts on possible impacts in the stock markets, depending on whether the Democrats or the Republicans win the presidential election this year.
Yeah, that's a great question. And I have learned just in the last few minutes, Jorge is a pretty educated individual. He used to be the head of Ernst & Young down in Peru. So I appreciate the question. It is one that we get quite a bit. And I can tell you that historically, the stock market has done well, regardless of whether or not a Republican or a Democrat was in the White House, and whether or not one party controlled the presidency as well as Congress. There are varying levels in there, and it's hard to make a direct correlation between one president leaving office one day and the next one starting. There's a lot of policies and procedures that get implemented in one presidency that don't really make their full impact until the next one. So I would say that of the research, the worst the stock market has done is about 5.5% a year. The stock market has obviously done a whole lot better depending on how the configuration of the presidency and Congress is. That said, I think we live in very unusual times. And lots of speculation. If Biden wins, that'd be the speculation as of today, but he does not control a super majority of Congress. I think Biden's going to get in and he will immediately stop on a lot of the harshest platforms that he ran on. So raising taxes, going after the wealthy, I think he will curtail that for two reasons. Number one, the economy is still not that strong. So you don't want to go and start taxing the heck out of your people when the economy is not that strong in the first place. Secondly, if Biden does win, he's not going to get elected unless he has the support of some really wealthy people. So it does not make good political sense, just from a pragmatic perspective, to immediately turn around and bite the hand that has fed you and elected you. So I'm not as concerned about a Biden presidency. If it had been Elizabeth Warren or Bernie Sanders or AOC, it might be a little bit different. But for all my Democrat friends out there, we've survived Trump also, and that's the great thing about capitalist society. Capitalism will win out in spite of the hurdles that we put in front of ourselves. And certainly our elected leaders are often as much foe as they are friend.
For sure. All righty, moving on. Looks like, would you say that you have any opinion on, I think it's Saratage or Saratage growth properties?
I used to own a little bit of it, and we just never followed through. So we're familiar with it. I think with a lot of those properties, I can tell you that we've looked at a lot of them. The only hard asset manager that we own is Brookfield Asset Management. And we have just found that they are very good at buying property, reconfiguring property, or injecting capital and expertise into it to maximize it and they do a great job worldwide. They will be a beneficiary of low interest rates as well as worldwide chaos. So as governments run out of money, they are going to have to find a capitalist-driven partner to come in, whether it's a shipping port or an airport or a toll road, whatever it might be. They're going to need somebody like Brookfield. So that is where the majority of our emphasis has been, as opposed to something like Saratage.
Gotcha. And increasingly, the biggest return on invested capital businesses in the U.S. are able to fund internal operations and acquisitions with internal cash flow. What function does the public capital markets serve to these businesses?
Well, again, it hasn't been that many years that Facebook and Google, Amazon, were all startup businesses. So early on, you are asking smart people with a lot of drive to come work for your startup enterprise. Generally, you work for below average wages and you get some sort of equity kicker. So you don't get to monetize that equity kicker unless you're publicly traded. I know, like with Howard Marks and Oaktree, he always said the only reason we're publicly traded is because my employees own part of the company and I want them to have a facility in which they can actually cash out should they want to. And so it may not be as much as it once was with some of those businesses, but I also don't think we've ever had businesses grow to that size that quickly either. So it may not be as apparent as to how the capital markets serve them, because the other thing is they really don't need to borrow money unless they just want to buy back a bunch of their shares or something like that. So it's not like Ford or GM having to go out to the capital markets to borrow a bunch of debt to build a new factory. These new digital divide type companies, a lot of the FanMag names, their ability to spin off cash flow is unlike anything we've ever seen before. So it's going to be very interesting to see how it plays out.
For sure. And would you consider investing in biotech pharmaceutical companies such as Biogen, which is specialized in making drugs for difficult to treat neurological diseases such as Alzheimer's or anything like that?
The truth be told, that is part of my arrogance that got me in a little trouble back in the 90s. In the 90s, it was kind of a golden era of pharmaceutical development, and the administration, the governmental administration, was far more favorable to developing and approving new pharmas that were being introduced. And we invested in a wide variety of those, and we made money on them. We made money because we were lucky, not because we were smart. I do not possess any ability that allows me to assess the patent or series of patents that goes into a pharmaceutical process or in component or in result that allows me then to sit there and go, oh, well, Pfizer's cholesterol drug is superior to company X. I don't have that. There's probably some ways that I could invest in that. If I did, there'd probably be like a large industry sell-off, and we would probably buy like an ETF that was just a basket across all of them. We do own Johnson & Johnson. In the case of something like Johnson & Johnson, you've got about a third of the revenues come from Band-Aids and baby shampoo and Tylenol and things like that. Very easy to understand. Another third or so comes from implantable devices, so artificial knees and hips, easier to understand. And then another portion comes from pharmaceutical development. Depending on how Johnson & Johnson is valued, there's enough revenue and cash flow generation out of Band-Aids and baby shampoo to where I don't have to be as correct on the pharma side. And as far as like the artificial limbs or artificial hips, knees, things like that, they're a little bit easier to identify how the cash flow works with those.
Definitely. So sticking with what you know, and what you think you're going to know for the
Yeah,
future.
yeah.
For sure. And what do you think of retail companies with low profit margins and high return on equity, return on investment ratios, things like that?
If they do have a low profit margin and they're able to generate high returns, that's a pretty unusual beast. Something like Walmart comes to mind. You're talking about 2%, 3% net profit margins. It's a very hard business to be in. We have owned Walmart historically. We have found that the profit margins at a Dollar General are a lot higher. The capital intensity of a Dollar General is easier to manage. And given the competitive landscape with someone like Amazon, I would not want to be Kohl's or Dillard's or JCPenney or a bunch of those. I'm sure there's some money to be made in somebody who does packaging up reorganizations. That's not us. And so I think there's easier decisions to make. But then again, because everybody a couple of years ago was so sure of themselves that Amazon was going to be the winner take all in retail, everybody sold out of Dollar General. And there's just a whole lot of people that don't shop at Amazon. And if you segment poorer people in our society, there's a lot of room for a Dollar General. There's also a lot of room for like a Ross Stores or TJX with Marshalls and Home Goods. So a lot of those off-price retailers, they have carved out a very nice place for themselves. I'm not sure that I want to have the high rent, high capital intensity retailer. They're not that well run to be able to survive and be a good investment.
For sure. And a question that tends to come up often when we talk about stocks at all in any form or another. How about Apple, Dave? Would you buy at their current valuation?
I am probably the world's worst person to ask about Apple. I will tell you that I struggle with Apple because it seems to be more of a US-based phenomenon. The rest of the world cannot afford $1,000 phone. But I don't want to take anything away from Apple because the ecosystem they have created is phenomenal. It is really something to behold. I don't think they're the best competitor. I think, they pull a lot of tricks that make it really difficult if you're not within the Apple ecosystem drinking the Kool-Aid. That said, we don't own Apple, but we do own Apple via our ownership in Berkshire Hathaway. And so we continue to buy Berkshire Hathaway. That gives us backdoor ownership into Apple and $150 billion of cash that also makes that investment easier to stomach. But on a device maker that is that expensive, I haven't been able to get my mind around it. And either my guys haven't pushed me because they struggle with the same things, or maybe they've just decided I'm just a cranky old curmudgeon and they don't want to, take that on. I don't know.
Definitely. And just to pose a little bit of a personal thought or question or evolution of that question in itself, there's been that I've noticed an increasing trend among these kind of, if you want to call them premium handheld device producers, to start to make a more value-orientated approach where they'll take, past bodies of devices and put better chipsets into them. Do you think that'll really change anything moving into the future for these companies?
It's an interesting question. There are certain ones that are more exposed to allowing themselves to be upgraded. So yes, I think there's the ability for that, but I think Apple does a pretty good job of trying to eliminate that possibility unless you are basically an electrical engineer and can crack those things open in that manner. So I don't know. I don't think that that's going to be a lead, but I do question if you can come in with an older model and soup it up and cut the legs out from underneath a new model that's being sold, then the company that is paying for all the development of the new device is not getting the premium that they would typically get before other competitors start to introduce a similar model.
Gotcha. And back on your personal numbers, what do you guys run as your margin of safety percentage?
It depends. Different assets are more obvious. Again, Facebook back in the spring, with that much cash sitting there, so capital light, there was just a very easy asset. The numbers were extremely broad. I mean, probably a 20% margin of safety on a discounted cash flow type. Something like Unilever is harder to figure out because it will depend on what their growth rates are. But with Unilever, what we found with even with a 9% discount rate, you were getting a really high quality asset at fair value. So it may not have been that it was just eye-popping, or, oh my God, this thing is a 50-cent dollar, we need to jump in. You were getting a very high quality asset that was very predictable and very consistent at fair price. And we have found that a lot of times it's better for us to buy something that is very good quality at fair price, as opposed to reaching for something that has been a little bumped and bruised and has some issues, but it appears to be quantitatively cheap. Things that become quantitatively cheap, sometimes there's a reason they're quantitatively cheap, and you don't necessarily earn your way back out of it.
For sure. All righty. And I know this will probably be a little bit of a stretch for you based upon some previous answers to questions, but do you have any thoughts on Ericsson's and Nokia's chances of succeeding in any 5G development?
No, not necessarily. We've taken a different approach on that. Historically, the last several years, we've owned Qualcomm because we recognized that they had the bundle of patents that allowed them to dominate 4G and 3G and 2G. And typically, whenever they come out with the next iteration, the next one has about a 10-year life cycle, and the new one that is coming out is always retroactively compatible. So 5G will be compatible to all of Qualcomm's previous technology. They may just not get as much of a cash flow stream off of those. Qualcomm, though, will still have a place in the 5G market. In terms of trying to sit there and say Nokia is going to be the winner or Ericsson's going to be the winner, that starts to fall into that category of, I don't know. I'm going to be really happy as a consumer to have a 5G phone once they build out the infrastructure, but I'm not sure that I want to make that as an investment. It gets back to the Ford Mustang issue. Great product, love using the product, not sure I want to invest in it.
For sure. And have you ever hit a 10 to 100 times bagger by investing in only companies with strong balance sheets which dominate?
Believe it or not, yeah. So Microsoft, we were buying Microsoft when it was trading for $20 a share. It was growing 10% a year and trading for 10 times earnings. And we would have clients get in our faces and tell us that we were the stupidest people on the planet. Nobody, quote, nobody uses Microsoft products anymore. And at the time, they still had something like 87% of the world's market share of operating systems. And even though there was lots of concern about dilution via tablets and iPads and phones and things like that, I mean, for those of us that work in the business world, everybody still had a PC. And the fact that they were able to make some of those turns and were able to make money in spite of Steve Ballmer lighting money on fire, that just told you how good of a business that was. So, I mean, you see where Microsoft is today. We've trimmed back very small amounts of it, but we've continued to hold that since about 20 bucks a share. So if you add in the dividend, it's well beyond 10 back.
Definitely. Well, I think at this point in time, that is going to round out the end of those questions. Last one being if you have any social media accounts for anybody to follow that you'd like to toss in a quick little plug where people can look out for any new and forthcoming information.
Yeah, there are so many great places to go for information. 25 years ago, we were starved for information, and now we're overwhelmed. But I will tell you, like Howard Marks, if he ever writes a memo, you just need to digest that. Obviously, Buffett, the same thing. Seth Klarman with Baupost, same thing. The reform broker, Josh Brown, he writes some cool stuff. Michael Batnick, he writes some interesting stuff too. The Investors Field Guide, Patrick O'Shaughnessy, he has some great interviews. And even if they don't lead to an investment specifically, just to talk about what's going on in industry and how industries are changing, those are really fascinating. I find myself listening to those 2 and 3 times because I pick up something else that's subtle in there that if you're not an industry insider, it may take me a while to digest it and really understand it. Joseph Wang that works in our group, he has a phenomenally broad range of places that he will go in Twitter sphere or wherever to read. But all of us typically share it across the table, and it makes all of us a little bit better. But those are probably the ones that come to mind first and foremost in terms of who's writing and insight in intellect. I really appreciate.
Definitely. Well, that'll round things out for all of our questions here today, Dave. Thank you again for taking the time to answer these questions remaining from our leftover chat questions and for being a longtime supporter of us here at GuruFocus.
Not a problem, Graham. It's really enjoyable, and any other questions trickle in later, send them my way.
Absolutely.